Yeah, good evening, friends. I'm Ashish Agrawal, Director, Resurgent India Limited, and I'd like to welcome all of you in this today's webinar, which is on very important topic, which is this recent trends in green financing for sustainable development. I think this is the future for all of us because the way the climate is changing and the global warming is there. We need to, I think, discuss, debate, and create awareness that how this green financing or the green projects can be helpful for the future generations. So, friends, I'd like to welcome to all the panelists who are here with us. They are practitioners. They are into green financing. They are having experience of funding in the green projects and green organization. So they will discuss about the nitty-gritty of this green financing. What are the opportunities? What are the challenges? Then we have the delegates and audience, those have joined us from various background. So bankers, professionals, corporates, and the rating agencies and the funds, investors. So it's a good, I think, I'll say mix of people who are there actually, and we all are discussing about the recent trends in green financing for sustainable development. So, friends, you know that the infrastructure development depend on the availability of finance. Without the availability of finance, the infrastructure cannot be developed. And as we have seen in the due to the poor rate of return and the significant risk involved in the long gestation project, most of the financial institutions are interested in financing fossil fuel projects than the green ventures. So this is the I think the area which we need to discuss today in detail. Then you see that this funding, green project, increasing funding for investments that are in sync with the environmental benefits. So I think we need to have the various instruments, financing instruments like green bonds, the green banks. When we have banks, why can't we have green bank in the country? So that is another area which need to be discussed. Green central banking, then fintech, the community-based lending, green funds. So there can be the many instruments which can be helpful toward the green financing, and there can be the institutions. Those should be there who are specifically funding to the green projects and green or the sustainable funding. And you see that there are lack of sound and verifiable green financial products in the market. So still the market is evolving. And if you see the green bond, I think, which is a fixed income instrument, it is getting some traction, but still there are a lot of challenges which are facing in the raising of green bond for long term. So this we need to discuss also. And I think the goal of green financing is to enhance the amount of money flowing to priority areas for sustainable development from public, private, and not-for-profit sector. So I think there is requirement that the all stakeholders should come forward, whether it's a public or private and the non-profit organization, and they should discuss and then I think finalize or take up the lead that how these green financing can be, the flow of green financing can be there in the system, so that whatever the requirement is there, it can be met out on timely basis. And I think if we see this webinar, which the purpose is mainly to brainstorm the recent development in the field and in this field, and what are the challenges we'll discuss also. So the key discussion points will be the hurdles, whatever the green bonds are facing in becoming an alternative parallel instrument to corporate bonds. Then the measures needed to boost fund flow to clean energy projects in sectors such as transport and infrastructure. Dealing high borrowing cost, I think that's a major challenge as of today, because whenever we are talking about sustainability, the borrowing costs or the cost of funds should be very reasonable, because the benefits will be, I think, will come out in the long run. So that is important part which we need to discuss. And the false claims of environmental compliance. This is another area I think I've discussed on many forum where the people are claiming that they are doing something for environment, but the claims are not genuine, which is also and the definition of green loan or green bond or green funding, which is to be discussed in detail also. So we have good panel speakers here. I have a small presentation, which I think Rohan, you can just start it.
Sir, I hope my screen is visible to you.
Yeah, it's okay. So I think again we are discussing the sustainable development, which is very, very important, and where the green financing role will come, or whether climate financing or green financing. Then how we can basically mitigate the risk of the climate change or climate adoption, climate adoption also, which will also be helpful, and the green financing will improve. Next. So as of today, we have, I think, some numbers which are very big actually in terms of value. So as per the requirement of the financing in the green or sustainable, there's something 2.5 trillion funding is required actually. And if we in next the total 15 years, this was the requirement, and some 7-8 years are remaining. So if we see yearly, there is requirement of some 10 to 11 lakh crore of funding in INR terms, which is a huge requirement which need to be fulfilled if we want to reach to a certain stage, whatever the targets we have decided. Next. So there are the landscape for the green financing in India. So as of today, if you see, the government is also supporting a lot by way of concessional loans or concessional giving some subsidy on the various green projects, or I think I'll say green vehicle and all, electric vehicle. So as of today, this is there, but maybe after some time, this will not be there. And if you see, public share of international public green finance is very, very less in India. So this need to be increased also. And I think overall we see there is a huge need of funding requirement for the meeting out the target of sustainable development in our country. Next. So these are some of the initiatives. So internationally, you see that a lot of large organizations are there. Those are supporting a lot. And even the sustainable stock exchange also is one of the area which is, I think, taken care in the other part of the world. In India also, we are talking about social exchange and all. So this will helpful. This will be helpful also. Instruments, if we see financing instruments, loans and grants, these are the instruments which are there in the system. Then government is also putting some funds by way of some subsidies and all. And other than that, green bond and the credit enhancement schemes, I think this is the last one. The credit enhancement scheme is one of the great tool actually, where the financing institutions can get this advantage, and they can take out the large funding, and they can help the entire sector also. So we'll discuss our discussion. Government has taken a lot of national policy, I think, measures also. So the capital subsidy, as I discussed, also this market-based mechanism, public procurement. So government is procuring a lot actually in terms of making this sector vibrant. So if you see the electric buses and all, the government is giving tender at first actually. So the government is creating some kind of budget, and then the private sector will come forward also. And from the regulatory point of view, there are a lot of, I think, initiatives have been taken by the government. So BRSR, this is something where the listed companies are required to report in their annual report every year what they did on their side. Then this BSC Green X, the Green Index, and the Carbon X also. And the RBI include renewable energy projects into the priority sector. But this will not be sufficient. I think we need to include more areas or more projects or segments in the priority sector to take the advantage of this the green tag actually, which will be helpful for the entire sector, where the banks and the other financial institutions will take the lead, because they will get some kind of priority advantage when they are lending to this sector actually. Next. So we see what is the scope and the barriers. So scope we have already discussed, but there are many barriers actually which need to be taken care. So definitional in advocacy, definitely we need to, I think, a large definition we need to discuss, decide what can be the best definition so that we can cover up the entire stakeholders. Regulatory framework, still the government is taking baby steps, but I think there is need of more steps in that side. So there should be a very strong, robust regulatory framework should be there. Capacity definitely need to be increased, and this international carbon market and instruments of the trading of the carbon and all carbon certificates, which is also required, which will help. So these are the areas from our side which we think that these areas can be strengthened. Then this green financing or sustainable financing can be there in a big way, and which can help us for our future generations. Next. So future actions, I think after COVID, I think the government is also now active. And this, in short term, we need to have some measures which are immediate measures. And then in the medium term, we need to focus on the regulatory framework, which will be helpful. And then we have to see that how the private sector can come forward for this green financing, or how they can mobilize funding for that. And again, the long term, the policy measures are needed to be taken care, and the international equity, how this can come to the our system, where the large projects can be funded, and this can be helpful to the entire sector. Next. So there are challenges which we already discussed, I think. So mismatch between the long-term green investments, and so the short-term instruments are there, but long-term instruments are still are not there actually. If they are there, then we are available in very small number actually, and the investment in some sectors and technology are, I think, lopsided. So we need to increase, attract the international finance on that side. And I think we need to make this current financial sector also to make it vibrant, so that these challenges like high capital cost or lack of adequate debt financing and lackluster domestic bond market, these I think challenges or these issues can be taken care well in advance. So these are some of the challenges. Next. So these are the questions which are, I think, left behind us. Basically, what are the measures we need to take, and what actions are required. So we'll discuss in detail. So friends, I think this is brief from our side about the sector, what are the financing challenges are there, opportunities are there. Now I would like to invite our panel speakers. They are expert. They are already involved into that area, and they are doing very well in terms of green projects, green financing, either debt side or equity side. So we have Mr. Prashant Sinha ji, who is head of risk and special projects in Bond Bazaar. So Prashant ji, first of all, welcome to you. and he has very wide experience in the financing side. So I would like to invite him for a deliberation where I think I'll request him to brief about his organization, what is its bond bazaar and how it is helping the green financing actually. That is very, I think, important area which need to be discussed. And we would like to understand from you, Prasanji, that what measures are needed to boost funds flow to clean energy projects in sectors such as transport and infrastructure. Okay, transport is a big area actually, where we are seeing the EV electric vehicle in the all segments of heavy vehicle or light commercial vehicle, two-wheeler and everywhere. So we need to understand what measures are needed. And then the another question is the green financing for India needs a strong impetus from foreign funds to smoothen India's transition to clean energy. What steps should be taken to attract foreign investors? So there are two questions from you. One is that what measures are needed for the for attract foreign funding, and how we can boost the fund flow in to clean energy projects, mainly in the transportation and infrastructure. So thank you very much, and over to you, Prasanji.
Thanks, Ashish. Thanks for this opportunity. A brief about Bond Bazaar is a startup yet to be launched, but the idea is to deepen the bond market. So that's the whole idea of this Bond Bazaar. Indian bond market is at a very nascent stage. So the whole idea is to make the bond market very vibrant and a lot of participation from retail. Retail is almost missing. So that's the idea of this platform. Yet to be launched. We'll be soon launching within a month or so. We are into our final stages of launching. Now coming back to your question, you just said that India requires 12 lakh crore a year only for renewable. Now let me give you some number. The total wholesale outstanding of Indian commercial bank in India is only 30 lakh crore. Out of that 30 lakh crore, the overall outstanding to power sector is just 12.5 lakh crore. Sorry, infrastructure is 12.5 lakh crore. Power is just 5.5 lakh crore. So just imagine the scale what you are talking about, and you are absolutely right. We need this kind of investment, but see what's the difference? The total outstanding of all the commercial bank in India for power sector is 5.5 lakh crore, and we require somewhere around 11 to 12 lakh crore a year. Now there are 2-3 dedicated financiers in power sector. One is PFC, another one is REC. Their numbers are even abysmally low. PFC total outstanding to renewable is less than 25,000 crore. REC total outstanding to renewable is 10,000 crore. So see, where are we? What we require and what kind of fund is available, there is a huge gap. So there is no way Indian financial institutions, including commercial banks, can infuse such kind of liquidity which is required for the green financing. So then what's the answer? The answer is obviously retail, the bond market, and of course overseas money. Both are required. Without that, you can't achieve your goals, you can't achieve your number. Forget about goal from a climate change point of view. I'm now even talking about, forget for a minute, I'm not telling that it is not important, but for a minute, just come out of that and think about energy security. The way in which electrification is happening and the way in which electrification is required to make India a net energy exporter and not an importer. It's a question of energy security now, and any thermal project declared now will take at least 5 years. So the only answer to energy security at the moment is renewable financing or the renewable projects. There is no other answer at the moment. And how do you achieve that? So you need to tap to a bond market, but then the return expectations or the IRR expectations or the interest rate expectations of developers are abysmally low. They expect 8% kind of number, or even sub 8% in some cases. Now, if your SDLs are trading at 8%, where on earth you will get a bond market money for a 20-year financing at 8%. So the challenges are many. Challenges are the over enthusiasm in bidding, the tariffs that they quote. And Naveen is a dear friend of mine. He'll understand more, or he can contribute more, that the kind of capital that is required versus the kind of capital that is available, there is a huge mismatch. And the level of financing which is happening now, even the bond, whatever projects have tapped the bond market, they are tapping it for 3 years kind of thing. Now, you just imagine what will happen if all of a sudden you have 11 lakh crore of refinancing required after 3 years, other than what financing, green financing was already required. So it's what is happening right now is not sustainable, both in terms of domestic bond market and overseas funding, because overseas funding is coming at a very steep price. So what is required is some kind of rationality in bidding to take the cost, understanding the kind of capital demand will be there. The cost of capital needs to mimic that. And if we need to really attract overseas money, which is possible, but after the Ukraine war, the things have changed completely. The entire Europe will go very aggressive on renewables. All these countries will look for energy security. So the capital demand will be huge, but the supply of capital will be limited, because capital requirement is coming from even from Europe, which was not there. So if we need to attract capital, and that too at a cheaper rate, the overall country's rating needs to go up. Okay, that the risk right now India attracts capital, but it's more of an equity capital for green financing. The debt capital is limited to very few, and that too at a very high cost, not the cost at which India needs to attract capital. So the challenges are many, the opportunities are many, so are the challenges are many, and the answer is not very straightforward. The answer is on various fronts. One is, of course, we need to deepen the bond market. We need retail participation to supply to the demand. And of course, we need overseas money, which is increasingly going to become scarce because of this Ukraine war. And for that to happen, also, we need to have a better rating. The sovereign rating has to go up.
Right.
So that's it. Yeah.
Thank you, Prashantji. I think you have covered up very well. So one, I think, big thing which you have told, that retail participation, that's the I think object of your organization also, where you are planning to launch this bond bazaar kind of solution. So from the retail point of view, still the retail participation is not there in the corporate bonds of today. Still it is at very low level. So if we see from the green financing or green bond point of view, how the retail participation can come, what are the areas or what are the suggestions you would like to give to the regulator or maybe the government, if they can do these kind of I think take these kind of measures, or these kind of initiatives will be taken up by the various stakeholders, then the retail participation will come in the green financing or green green funding.
See, the retail is right now not in a position to underwrite a 20-year risk. Okay, it's just not possible. So expecting, and it's not prudent also to bring retail directly into a 20-year kind of paper, or a 3-year kind of paper with so much of risk, which retail doesn't understand. So what is required to deepen the bond market at the moment is there has to be some sovereign company, say for example NABFID, who can underwrite the risk in a sense by giving credit enhancement or a credit guarantee kind of thing, of course with certain terms and conditions, and taking a guarantee fee for it. And with that kind of guarantee coming in, then only you can deepen the bond market. There has to be some some intermediary in between who understands the sector, has the ability to underwrite the risk and then offer a risk-free instrument to retail, which can compare with their alternative investments like fixed deposits, post office, or G-Secs. So you are competing with sovereign papers like G-Secs, SDLs, fixed deposits, post office deposits. So if you have to compare with that, then it needs to be at a risk neutral basis. It can't be at a risk skewed basis. So that's the only way I see a bond market can be deepened. But nobody is thinking on those lines. Although we can form a task force and give these suggestions, such suggestions to Government of India and
Okay.
see what happens here.
So good suggestion. I think just to add in that, there can be some, I think tax-free bond can also be one of the area where though the retail participation can also increase in the green bond. If we are raising green bond, and then there can be some government initiative on the tax-free side. This can be,
Definitely.
yeah,
Definitely, but all I'm trying to say that we need to guard retail from credit risk. So tax-free bond, of course, PFC can raise, REC can raise. There has to be some sovereign intermediary who can raise this tax-free bonds and then deploy. Retail can't directly take exposure on
okay.
projects individually.
Yeah. So one more thing, Prasanji, although I know you are getting late actually. So just a last thing. This emotional capital will also help in that, because everybody is concerned about the future of our children and all. So when we are talking green financing, there be any emotional play or emotional thing can be attached with that. Will it be helpful?
Definitely, definitely. But again, I'm telling you, you need to take the credit risk out of the sector. Okay, you need to take the credit risk out of the paper. If you can't take the credit risk out of the paper, then if somebody has to choose between FD or a post office investment and a green investment, obviously people will choose green investment even if it is coming at a 25 paisa lower interest rate. Okay, so we need to play we need to play that game, or the country need to play that game for sure, but not at the cost of credit risk. So anybody who wants to understand the green financing and wants to deepen that market, one thing is for sure that they have to take the credit risk out before offering to the retail.
Good. Thank you very much, Prasanji, for I think your views are very, very important for all of us. So, friends, now we have another panelist, and he practitioner in the green energy side. Mr. Naveen Khandelwalji is there with us. Who is the CFO and the COO of a company called Bright Night India, which is a MNC, the energy space. So Naveenji is having very good experience on the renewable energy side, and he has raised a lot of money on this side also, more than 2 billion USD. So nobody can be better than him. So first of all, Naveenji, thank you very much for joining with us, and welcome to you. And we would like to understand from you your experience in this space, whatever you have done in the past, and in the current scenario, what do you suggest to the audience? And whatever what are the key trends and recent developments in green finance in India, because you are also currently involved into that. So you'll be knowing that what are the developments in the green financing side, and what sort of challenges do green bonds face in becoming an alternative to an instrument as popular as corporate bonds. So over to you, and thank you very much, Naveenji.
Thanks, Ashish ji, and thanks everyone for especially two of you, Ashish and Prashant, I think, who was left for some urgent personal matter.
Yeah.
But yeah, issues raised by both of you are very, very pertinent, and I think I'll try to add to some of those points, and would like to add some new points. So let me start by a couple of comments which got made, and then I'll talk about what has been the journey and what how the future looks like. So first and foremost, I think one comment which got made is infrastructure wants lower cost of capital, and which is not easily available. My view or comment on that is infrastructure actually has to be funded with lower cost of capital, because that's the nature of infra. But the key in that, or the key aspect of that, is to attract lower cost of capital, the de-risking has to happen, right? That's the way infrastructure is done globally. That's the way we have also been thinking in India, in fact, doing in India. But sometimes the risk exposure given to the developers goes beyond a point, and that ultimately forces developers or investors to ask for more return on capital. And when I say investors, actually that includes both equity and debt. So that's one part. So I would not sort of completely agree with the fact that infrastructure, because it pays lower or returns are lower, it is able to or unable to attract capital. My view is idea has to be de-risking, thereby to bring cost of capital down, and that's how we should fund infra, because that's for the long term. And infra is a multiplier or enabler kind of an investment in the economy, not supposed to make FT returns any which way. And we have seen multiple such examples where if the project structuring was done in a very good way, cost of capital actually came down by a significant number. Though there are examples in roads and ports and other not ports, roads mostly, but I can give examples from our own sector, which is renewables. The first such project which was very beautifully structured was Reva Solar Park, which actually attracted both lower cost of equity and lower cost of debt, because the de-risking of various factors was done in a very, very systematic manner. So that's part one. Now, part two is, or the point two is, we also need to, so solution now, the solution of the larger problem which we're discussing. I don't think there is any single solution which is going to work here. There is no panacea to make capital available for the sector. I think we need to do a multi-pronged strategy wherein we kind of enable capital flow from various pockets of capital, various pools of capital. Now, short-term capital, medium-term capital, long-term capital is one categorization. Domestic capital versus international capital is second categorization. And that would, of course, equity debt is a much larger categorization, but I'm currently focusing on or planning to focus on debt more, because that seems to be more sort of area, a more focused area of the webinar, though we can discuss equity as well. So talking about debt now, the third aspect is, though we keep hearing talks of subsidized finance, tax-free finance and all that, I think we need to split even that bucket. Sector has matured. I don't think many large players anyway are looking at subsidized financing or tax-free financing. The reason for the same is, I'm not saying we should say no to that, but we also need to look at sustainability of the same from the larger economy perspective. So the way it should be seen, the way at least we think about it and we suggest or kind of advocate to the government is, sectors or part of the sector which are mature, I think they can attract private capital from private markets or public markets. But the sectors or technologies which are yet to mature, which are need of the hour, and a couple of examples are like storage, hydrogen, the new frontiers of renewables or green energy. That's where some kind of support, if comes from federal or state government, either by way of tax or by way of some other kind of interest subvention or subsidy, that would be desirable, because that would limit the exposure of government also. Expecting lower cost finance or subsidized finance for wind and solar and all these mature technologies, I don't think is going to go very well, both with policymakers and maybe other stakeholders. Now, let me go back to your question after commenting on these points, the trends. So let me start with positives first. Trends, I think for last 10 to 15 years, trend has been only positive, very encouraging. The availability of capital has gone up tremendously. Because in let's say 2010, 2012, when we used to do projects, by the way, that time project size also used to be 20, 30, 50 megawatts, not like 300 to 500 megawatt each project, which we're doing now, right? So project sizes have gone up, so is the debt requirement. But good thing is market has, or market means the capital providers have actually kept pace and matched the capital availability to the sector. Of course, there are nuances, who gets it, how does one developer gets it, and get it, and why some are not able to get it. But overall, I'm making a larger comment. The capital flow or capital availability for green finance has gone up tremendously, both domestic and international, both public sector and private sector. Again, both uh, public capital markets and private capital markets. So overall trend is positive. Second is um, understanding of the sector. Understanding of the sectors by various investors has gone up tremendously. Earlier, we had to struggle to explain to lenders how renewables was different vis-a-vis a typical thermal power plant or gas power plant or hydropower plant. I think now all that is behind us. All lenders, most of the lenders, more than 25, 30 of them at least, very well understand how it works and what is the need. Third thing which has gone very positive in last 8 to 10 years is beyond utility side market of renewables, which is large scale long-term PPA market. The open access and distributed renewables, which are mostly rooftop solars and open access wind and solar and hybrid projects. I think capital availability for this segment has also gone up, which is actually a little bit different from utility scale projects. So appreciation of nuances or risk factors of these kind of projects is also increasing in the minds of lenders and equity investors, and so is the capital flow increasing. Recycling of capital. That has also seen very good positive trend in last at least 3 to 5 years, if not more. Earlier, banks were, let's say, the single biggest source and supported by private sector banks and NBFCs, right? And Prashant, who is a good friend, had contributed to or has contributed to the sector in a big way because he was head of risk at L&T, and he was the one who used to give comfort to his credit committee after going through all the technologies, all the credit exposure and all that. So he actually, and L&T has been a very, very good contributor to this sector because that these kind of institutions extended support to the sector when not many were willing to do that because they were not able to understand it. So that has gone up, and because NBFC and private sector banks had funded it, it anyway required a recycling of capital, which has happened. If we talk about bond transactions in last 3 to 5 years, I think there are enough and more, or enough and many. So both at domestic level as well as international level. I'm nowhere trying to say that is sufficient and we don't need more. No, we need multiples of that. But as a starting point, we have done reasonably good. So capital supply from bond markets and capital markets has improved. So these are the few points I thought I would make on trends, and now shifting to issues and the areas which areas where we still require a lot of work, because the kind of capital which is needed, as Prashant hinted on, it is going to be at least more than 100 to 150 US dollars equivalent per year. If you were to take the targets which have been set for us as a country, which is 500 gigawatts of non-fossil renewables in next 7 to 8 years time frame, that would require that kind of capital, right? Now that of course cannot come from one source, as I mentioned previously. It has to come from all the pockets. So multi-pronged strategy, multi-directional efforts is the way to go. No single solution is going to make it work. So on that, I think first and foremost is deepening of bond markets. I think what we can do, we means India can do, is deepening Indian bond markets. We can do limited when it comes to US dollar bond markets. But I think USD bond markets are anyway much deeper. The only issue for us is how do we access? How do we increase the access? But otherwise, I think market maturity is anyway there. Indian bond markets, again, I generally split things into various buckets. So generally, bond markets are shallow in India. First of all, corporate bond markets in general. And on top of that, green bond market is further shallower. So we need to address both the aspects. Corporate bond markets deepening, and I'm sure many stakeholders are working in that direction, starting from SEBI to RBI to various fixed income investors and other sort of advocates of corporate bond market deepening efforts. So efforts are happening, but there are issues which would take some time. But directionally, we are on the right trajectory. And on top of corporate bond development, corporate bond markets development, then we need to add flavor of green, which is going to have contribution from multiple aspects. And one of that is going to be emotional capital, Mr. Ashish, because that also plays a role. We have seen that happening in EVs, that happening in renewables, that people in general have good ambitions, good will, and good sort of thinking about the future. So as long as they're not getting incremental risk or are not being forced to pay incremental, I think people will make that choice for themselves easily that green is better than black or brown. The question is, if we start asking people to either subsidize or pay from their pocket for green, then it becomes a difficult question. So how can we address that bit? That green is giving at least equivalent returns directly or indirectly or by support, then I think the green would anyway have many takers or more takers than the black or brown takers. That is happening across the globe. Capital flow for sustainable and green finance is only increasing. So no questions around that. So that was first point, bond market deepening. Second is the tenor announcement and taking investor community along when sector is maturing. Why I say that? That is very critical aspect. So as I mentioned previously, availability of capital for wind and solar has gone up now. No more a challenge. But the point is sector itself is now maturing. Plain wind, plain solar is not going to make the cut, is not going to make the journey easy, especially the level of transition which we want to see. So what we are now currently focusing on, organization like ours, Bright Night and a couple of more people, we are trying to look at the dispatchability of renewables, right? High PLF renewables, multi-technology renewables, which can actually replace thermal generation, which is mostly coal, and maybe limited gas. Gas anyway does not contribute much in India, but mostly coal. Now to add dispatchability and to add firmness, you need multi-tech solutions. You need a lot more complex project structuring. Now, developers are trying to do that with the help of internal teams and consultants and market trends and all that. We need to take investment community also together. Equity investors are anyway moving forward very fast, but I think lending community has to come along. We need to take them along where we talk with them, or rather when we take them along in our journey when we are saying we are going to supply round the clock renewables, RTC, peak power renewables, hybrid renewables, more storage solutions. All these are newer technologies, would require better and higher appreciation by the lenders before they can actually write the checks for these kind of complex projects. So that's my second suggestion, that we need to have more engagement between developers and lenders or debt providing community, so as to have them along our side to support with the supply of capital. And last part is actually complementary with what Prashant was saying, is credit enhancement structures, because that is a major bottleneck when it comes to supply of capital, because of the counterparty in our business, which is mostly discoms, which are anyway not rated very highly. And unfortunately, despite multiple efforts, that is taking time in going to the place or direction where we want it to be. Since that is taking time, in the interim, we need to provide these structural interventions or structural solutions like a partial credit enhancement, which has been experimented with a couple of times. It had limited success, but I think there is significant amount of work which is needed in this area. And very good example of that is, good analogy is the moment SECI was introduced in between to remove the discoms as a counterparty. Look at the supply of equity capital, look at the number of developers and bidders willing to participate in the tenders, and look at the benefits of that. Tariffs have come down so low. Returns, though Prashant was complaining about that, the bid rationality and why people are bidding so low, that's a different topic. We can spend a couple of hours only on that. But presuming developers are doing their job in a good way, the more important point is, if you reduce the counterparty risk, then cost of capital falls. So SECI did exactly that. Can we do that in the financial markets as well, by taking these projects which are now actually graduating from BBB category to A category on their own? Little bit of more support is needed to take them from A to AA. I don't expect easy achievement of AAA, but as long as we are in AA category, we will open up multiple pools of liquidity, multiple pools of capital, and that would enable what all of us want, which is the recycling of capital, bond market supply, stable cost capital to the infrastructure or renewables or green finance, which is the need of our if we need multi-hundred billion dollars in next 7 to 10 years, if not more. I'll take a pause here and I'll answer the rest of the points later.
Thank you very much. Thank you, Naveenji. I think you have very well covered the entire aspect from the energy point of view. So solar and wind, definitely a lot of traction is there, and it was started long back actually. If you see maybe 10, 15 years back, it was started and lot of headway has already been done. But if you see, it is on B2B side actually. We come on the B2C side, in the solar or wind side, maybe specifically on solar, rooftop solar and all. Still the challenges are there actually. So which need to be taken care. Otherwise, when we were talking about technology, innovation and all, these cannot be funded the way that is required actually. So good, I think you are very positive on this, and your views are very, very important. So thank you very much. Now we have Mr. Prasad, Jayant Prasad, who is Executive Director of Seekers Finance. So Mr. Prasad is a seasoned banker actually. He spent a lot many years in his career in the banking and funding to the sector. And now he himself is funding to the small people or SMEs or the households in the green energy space actually. So now his motto is to fund to green energy. So first of all, Jayanji, thank you very much for joining with us, and we welcome you. So we would like to understand from you, because now you are lender actually yourself, and your company motive is to green finance only. So we would like to understand that how big is the opportunity size for clean energy adoption by households and SMEs, first of all. Then what are the barriers for financing for them? Can green finance address this opportunity? So this is one question which is very relevant from your profile. And then the other question is, the existing tools of green finance are skewed in favor of the debt instruments. What are the challenges in expanding the realm of green financing? So over to you, and thank you very much, Jayanji.
Thanks, Ashish. Thanks, and wonderful thoughts by the panelists before me. So one of them was a good segue into the question you asked, that what is the opportunity we are talking about when we talk about household and SME clean energy demand. Just a quick add-on to what you described on Seekers. So we are a specialized NBFC. We fund clean energy. And within that, we have funded rooftop solar, rural energy access, electric vehicles, waste to energy, and waste water recycling. So this, and industrial energy efficiency. This gives us a good sense of what all is happening beyond utility solar and utility wind, which is where a lot of the attention has been, right? So we are looking at these sectors. So the segue I had was, look, if you look at it, when you're doing a clean energy transition for a country, there are two sources of demand. One source of demand is what I call government auction demand, where government goes and signs a government discom or a government counterparty like NTPC goes and signs a PPA, which a private developer develops, right? When government auctions out 10 gigawatts, 10 gigawatt gets developed. When government auctions out 1 gigawatt, 1 will get developed. When government auctions 50 gigawatt, 50 will get developed, right? So depending on the ambition and the pace of execution by the developers and the government ambition, there is a volume which will get deployed on solar, wind, hybrid, storage, etc., which I call is government demand. A lot of the debate which preceded this was around how do you get capital flows to go in from the banking sector, the bond market, the international sector into this, right? There is, however, an equally important component, right? And not optically visible, but very sizable component when you look at non-government demand. Now let's color that. The amount of rooftop solar which can be put on roofs exceeds what you're targeting to put in the utility solar sector. There is at least 400 gigawatts of rooftop solar which can be put up on roofs at with positive unit economics, meaning the person who's putting the rooftop solar will save money, right? Similarly, when you're looking at vehicles, right, you have about 20 million two-wheelers and about 300,000 to 400,000 odd four-wheelers and above getting sold, right? A little more than that. 3 million to 4 million. I missed a zero there. Now, this is expected to go 3x, if not more, within the next 10 to 15 years, based on the fact that we are a country which is growing, our demand is growing. Now, all of this is going to consume materials, of course, but it's going to guzzle oil and CNG, right? If you have to transition this, then you need to move to equivalent electric vehicles, two-wheeler, three-wheelers, etc. and they need to get financed by vehicle financiers, and the infra for them needs to get financed by infrastructure financiers, right? So when you look at it from this lens, and there are solutions outside this realm in terms of what I had colored in energy efficiency, etc., the opportunity is significant. What happens is the entire view of 20-year asset financing for government demand does not apply to the assets when you go here, right? For households, you want to do short duration finance. SME, you want to do medium duration finance. Vehicles, there is very short duration to short duration finance, which has to be deployed. When you're going to industrial energy efficiency, the capability for delivering the projects and financing the projects, those comes in, right? So when you go down to that path, you say, look, are there existing delivery mechanisms to fund assets in that sector? And you find that except vehicle finance, which is largely NBFC dominated when you're looking at two-wheelers and small four-wheelers, not cars and heavy trucks. Except for that, there is very little asset financing which happens in the market. Most of the banking system is geared towards either large project financing or towards property-backed asset financing, right? So if you're an industrialist, you want to set up a factory, you have to put a property. You want to buy an electric vehicle or put a solar rooftop, you have to put a property. That is not necessarily an encouragement or inducement for people to go green, which is where from a seeker's perspective, the challenge we had taken up on us was we said that, look, when you go to distributed finance, the existing financing mechanisms may need some amount of pump priming or path showing to discover risk, to discover financing mechanisms, and then transition to start funding those people as a business opportunity rather than as a compulsion opportunity, right? So we have been funding distributed projects, and we are working with other financiers, and we are showing pathways to banks on how do you start funding the distributed rooftop solar for SMEs, household, electric vehicles, etc. Right? In my view, the amount of capital going into the utility solar and wind sector combined can be matched by the amount of capital going into the distributed sector, and that is not just a theoretical possibility. In Europe, that is how it goes. The amount of capacity being created outside of utility sector is matching or comparable to the capacity being taken out by the household and the SME sector, right? And that is even before you count vehicles. So I think this is something which is a big opportunity, and there is a pathway for financiers and innovators to target this. And it's not hamstrung by 20-year financing requirements. There is a lot of money-making opportunity on the shorter duration out there. The issue is the banking system has to reorient to start funding assets without necessarily demanding property collateral, and see the NBFC system capabilities which exist for funding assets need to get leveraged and need to get transitioned to start to fund electric vehicles and other distributed assets. So on the first question, I'm pausing there, and I can color that a bit more, because the second question was also quite interesting, right? And that's also a longish topic. What are the financial opportunities beyond debt, right? For that work, we have to first understand that when we are talking clean energy transition, that gets split into stuff which is already viable. Like if I want to put a rooftop solar on my roof, it is already viable, right? So you're funding what is viable based on my credit profile or Government of India's credit profile or some corporate's credit profile. There is also a large amount of solutions which are required for the clean energy transition, which are on the margin of viability, meaning you are just about break even, or a little distance away, right? So when an earlier panelist referred to things like hydrogen or other things, right? They may be 10 years away or 20 years away from viability, right? The question is, when you're looking at the spectrum of returns or the instruments you use, and when you're hearing demand that, look, there needs to be de-risking, I mean, either you can call Government of India to de-risk, or you can appeal to a higher authority than Government of India, right? But eventually what you're talking about is you're solving for two things. One, what is already viable, how do I fund it, right? Debt and project equity are the right instruments for what is already viable, right? Because if it's already viable, there's no more concessionality needed. What is not already viable, that's where you have things like, government giving subsidy, like they are doing FAME subsidies for electric vehicle, to bring it closer to the upfront cost comes closer to the fossil fuel vehicle cost. Or you have other instruments. For example, I think in the pre-brief, Disha had referred to an afforestation fund, and I would love to hear how that kind of a thing works. But there are pools of capital available globally, other than charity, other than just CSR, which are trying to target these not yet viable sources in terms of improving viability there. Now, some of those pools you can start tapping on things like how to build resilience on villages against floods, against droughts, how to improve agricultural practices. What is viable? Debt market is the best debt is the best way to finance. What is not viable, then you need these alternate instruments where people will accept either a emotional return for viability, or people will subsidize or otherwise compensate people for moving to a higher cost, right? I mean, for example, why would you ask a daily wage earner to subsidize the carbon dioxide pollution committed by the whole of the globe on his own balance sheet, right? So you have to give him some incentive to switch from a fossil fuel, a diesel three-wheeler to a electric three-wheeler, right? So you can't say that, no, you take all the risk and we will get the benefit of the reduction in carbon dioxide pollution, right? So that is where the alternate forms of capital are there, and there are instruments which are being tried out globally, which have relevance and audience in India. So I'm pausing there. I'm happy to take follow-up questions on this.
Thank you, Jainji. I think you have taken very well. I think one more thing which we'd like to ask from you is Seekers Finance, which is, I think, specialized NBFC. So what kind of challenges you are seeing from the funding point of view in terms of your funding for the basically in the shape of debt and equity? Because you see in the current scenario in the banking system and everywhere, there is no tag for green funding actually for any institution. Actually, they have the mixed pool of the funding.
I would agree, and that's a very important topic, and I should color that. And this is not only relevant from Indian perspective, but global perspective. Globally, there is a lot of money which wants to chase climate finance, right? In India, there is some amount of priority sector allocation for, let's say, solar projects, etc. But the banks have no compulsion right now to allocate capital. Even the recent discussion paper RBI had come out with makes these targets voluntary, despite the fact that the country has committed by 2030 to achieve certain emission intensity reduction. These are voluntary targets. Now, when someone like us, therefore, goes into the capital providers in the domestic or global context, what we hear from them is, oh, if only you were 1 gigawatt plus, or if only you were 4As, right, we would have given you money, right? So they want to invest in climate, and they want to invest it without taking risk. Similarly, when you go to banks, they said, look, there are 2,000 plus NBFCs which are active in the Indian market. I mean, I'm sure there are more, but that's hypothetically. Why should we give any money to you? I do not have a line which is called climate line, right? So even people who have raised green bonds are happily able to put that money into large utility scale projects. And when you try and explain to them that distributed can add equivalent capacity and far more public awareness, right? Because public awareness in India also needs to build up, right? If I put a rooftop solar plant on my roof, my awareness goes up, right, on climate issues. Public awareness raising also, there is a benefit, and there is a decarbonation which can accelerate the pace at 2x. They're like, sorry, it is not there in any circular, any policy, anything, right? So there is a challenge that the global climate investor, as well as the domestic banking system, when it is coming to investing in us, right, they are typically looking for very large government, mostly government or very high rated corporate backed pools, and they're happy to just contribute to them. Now, incrementally, that is adding capacity. It is showing a success and attraction to us, and we have heard some demands on how that could be improved further. But there is a whole market which that leaves out, which we are trying to catalyze.
And rightly said, whatever you have communicated to us, it is important that there should be separate lines for the people who are funding to this sector at the lower or unserved or underserved people. Actually, I'll say that will be helpful to, I think, take up this agenda further. Thank you very much once again. Now, friends, now we have the last speaker. She is this Disha. We have Ms. Disha Gandhi. She director in Avishkar Group. And Disha is having very good experience of investing, editing, and monitoring or helping the investing companies from the fund point of view. So first of all, Disha, welcome to you. And thank you for joining with us at very short notice in our webinar. So Disha, we would like to understand from you mainly from the equity point of view, because you are the Avishkar Group taking the risk when you are investing in the company which are in the initial stage, and you are investing and then helping them also. So what are the challenges are facing by the investing company when we are talking about the green sector or the environmental solutions which they are providing? And other than that, you see, in terms of several stakeholders have proposed to include negative list in order to explicitly exclude investment in the fossil fuels and other activities. So many funds or many investors have put that condition that whatever the investment should be done, we'll do the climate friendly companies or climate friendly sectors. Yeah, is this a pragmatic idea, or how will it affect the private investment and fund flows? So over to you, and thank you very much, Disha.
Thank you so much for having me. And it's a very pertinent topic that we all are discussing today. There's a lot of interest in understanding more about the opportunity that green financing today brings to an economy like us. Before I start, I'll probably give a quick introduction to Avishkar Capital as well. So, Avishkar Capital is a 2-decade-old impact-focused venture capital fund. We manage close to $500 million of investments, primarily equity instruments in early stage and growth companies. So our experience, because we're impact focused, we primarily look at green, social, and sustainable ventures, right? These are the kind of sectors and companies that we look out for. So we've had a good experience of investing in companies that are in the circular economy, that are trying to do something in the sanitation space. Energy is a sector that we've been closely monitoring as well from an equity investing perspective. And we have our own thought process on that as well. Coming to your question on, what are the kind of challenges that our investee companies have faced or their experience in trying to raise green financing. Look, I think the important fact to be established over here is that most of the enterprises in the country, especially in the early stage, and in operating in green sectors, are aware of this financing channel today, which in itself is a very big first step, right? Because probably a decade earlier, this was not a talked about topic at all. And everything fell on the traditional financing instruments. So I think from that perspective, there is at least a keenness and an awareness to explore. The pools of capital that are made available today largely come from it, especially for enterprises, they largely come from foreign institutional investors, because as the other panelists mentioned, those lines are not being made available by the Indian institutions today. So you have no option but to fall back on sovereign wealth funds of developed countries, multilateral agencies like International Finance Corporation, World Bank, etc. Right? And where the challenges sort of start coming in is if you're a large group, it's easier for you to access those kind of capital pools because you will have an entire ecosystem that will enable you to do so. Versus when you are a growth to early stage sort of in company, you don't even have the right set of advisors that are available today. I mean, a lot of the investors or the other panelists over here have had experience in raising debt. If you were to go and speak about advisors that are available for just normal term loan or ECBs, you will have at least 15-20 names crop up. But if you go with a very specific agenda of I want to raise green bonds, then there are very few specialists out there. And I think Resurgent is one such entity who is trying to develop a program on that front as well. So it starts with that. Second is the compliance and the regulatory costs that get added as well, because today for an enterprise, from a commercial aspect, there isn't too much of a difference between a normal ECB line being made available versus a green bond that is being raised. And that is where the commercial aspect also comes in, with the added compliance cost of your audits, ESG, your environmental sort of diligence, etc. So these are the kind of challenges that that enterprises usually face. And to your second question around, what are the debate around negative lists and whether they should persist or not. I think as a fund, as an equity fund, we ourselves are faced with those challenges as well, because we've raised capital from a lot of development financial institutions across the world, multilateral agencies, and they come with their set of requirements on what is permissible as an investment in certain sectors and what is not. So we typically work with an exclusion list. I think this debate in the context of green financing is particularly interesting to watch. Both factions of the people who are in favor or against this kind of a structure have very valid points, and I think it all boils down to the mandate of the capital owner. What is the intent with which the capital is to be deployed, and finding an alignment with the end use of that is important. Right now, most of it seems to be channeling towards renewable sources of energy, but green financing needs to go a lot more beyond energy and energy efficiency. It needs to extend to sanitation. It needs to extend to circular economy. It needs to extend to industries as well. Just to give you a simple example, lead acid recycling is an extremely polluting process. But if there is a company who is trying to revolutionize the process by making it more carbon efficient, are we saying that a green financing option may not be available because of the typical or the traditional nature of industry being polluting? Then how is innovation going to come about in traditional sectors as well if those capital pools are not being made available? So I think there is an argument to be made at both ends, but at the end of the day, it all boils down to matching the mandate of the capital with the usage of the capital. And I think advisors and intermediaries out there will have to play an important role.
Thank you, Ms. Gandhi. I think you have very well covered from the fund point of view. I think we'll need to know little more from you from the fund point of view. Basically, when you are evaluating any company which is into the sustainable development or green projects and all, so how do you differentiate in your evaluation criteria whenever anybody approaching, which is one company which is into the normal business, another is into the sustainable development business actually? So is there any different way of evaluating these organization and the tenure of funding which you are giving? Because in case of sustainable development, the long term, I think equity is required. So please.
Sure. So I would love to share our experience as well over there, and it very well resonates with what you mentioned, right? We have been constantly trying to bring about the awareness around impact financing. We started impact investing before the word impact investing sort of was coined, right? So our objective was to just take capital to entrepreneurs that are trying to create some sort of a double bottom line, right? That was the broad intent with which Avishkar was started. Having traced through multiple funds and our 20 odd years of journey, the experience has been that because there is no dedicated line of impact investing or even green financing, you are forced to be slotted as a particular type of investor, right? And that depends on the risk metrics that you fall under. Because we've been investing early stage companies, we tend to be slotted along with all venture capital funds. And the pools of capital, unfortunately, today are not evolved enough, especially on the equity side, where you get access to pure impact financing. It's either grants that you get access to, or you get access to risk-based instruments like equity. And over there, then what happens is that you are forced to fit in those structures, which are typical 8-year, 10-year long funds. You have a particular sort of structure, deployment schedules, etc. And that's the way you need to really sort of go after. Our own experience has been that enterprises that are trying to do something different, especially around renewable energy, etc., need to be looked at with a different lens and have a different tenure of maturity attached to it as well, and a different returns profile as well. So from that perspective, what we have been able to devise as a strategy is we have raised multiple funds and we've picked out the heroes from our earlier fund and doubled down on them so as to extend the horizon of our association and our support to them as well. And there are multiple such examples in our portfolio companies that we've managed to do. So we've seeded them and we've taken them across multiple fund cycles, till they are into their series EF stage as well. And unfortunately, from debt structure perspective, it may not really work in the same way, but at least from an equity standpoint, those are the kind of structures that we are evolving. But we are the flag bearers internationally to say that this needs to change, and hopefully one day we will see the change as well.
Thank you, Ms. Gandhi. I think you have very well covered this point also. So, friends, now we have some questions from the audience, and there is a lot of questions. I'll take one or two only because of scarcity of time. So, this one basic question which has come from Mr. S.C. Agrawal. He asked that what is the difference between green financing and non-green financing, which we are discussing the last 1 hour actually, and for what purpose? So somebody can take this question, we see a difference between green financing and non-green financing. So Jainji, can you highlight on that if possible?
Sure. And this difference gets technical, but broadly, just very, sorry, can you hear me? Yeah, broadly, very simply put, green financing is currently being encouraged to anything which allows us to live sustainably on the earth. Energy is a big focus because a lot of the greenhouse gas emissions are happening from energy production, and that's causing all the issues with the climate and climate variation. But if you expand it wider, it's also around how do you use your material, how do you do other stuff, because the climate change part has come into fore because of the recent awareness which has built up around it. The issue has been known for 50 years. But there is a lot of other things we are over-consuming on the earth. So at this stage, there are definitions available. EU has a green finance taxonomy. I think India, there are a set of people working on green finance taxonomy. The regulators like RBI are bringing out discussion papers around it. So that usually defines what green finance is in the context of the debt market or the bond market or the equity markets.
Thank you. Thank you very much. So then we have one more question which is related to thermal and solar energy. Somebody asked about this question. This thermal or solar energy can be replaced by wind energy generated by small windmills, whose cost is 4 crore rupees per megawatt. Do you agree or not? Small windmills are 100% indigenous and are now manufactured in Bangalore. So, Naveenji, can you take this question? This is related to energy.
Yeah, sure. So I think though I'm not that much technical expert on small scale wind turbines, we have been doing only megawatt scale wind turbines. So yes, I have heard there are multiple options or solutions available on that side. So yes, that is going to get more support, more traction. And as I mentioned, and I think as a couple of other panelists mentioned, it is going to be multi-pronged effort. So one is wholesale market where we operate. One is retail market. So B2B, B2G, B2C, and C2C kind of a thing is going to be there for next full decade at least, if not more, maybe a couple of decades. So yes, these turbines are going to be helpful, but I'm not sure about their economics, their bankability, if somebody wants to avail loan against that. So, but yes, that discussion could be had. But otherwise, wind in general is, by the way, indigenously developed. So that is another thing which is getting discussed in the Indian industry. Wind is actually already wind has more than 15 gigawatt equivalent domestic manufacturing capacity. In fact, India is exporting a lot of large scale wind turbines to many countries. So that way, wind is a good job creator in India, and we expect same thing to happen with solar in next 2 to 3 years, if not earlier. Yeah, but to come back to the main point, yes, that would be or should be helpful. Jayant wants to add, I think.
Sure, and the question, I mean, my addition was again not limited, not based on the specific cost of wind turbines, which I'm aware of. It was limited on that same point I'd made around government demand and private demand. A lot of the questions which you're raising out here or seeing out here, or we're seeing outside, are how, as a private consumer living in a city, in a village, or a small factory, can I reduce the carbon emissions, right? There are many solutions and technologies. There are ecosystems around solar rooftop which are well developed, many others which are not as well developed, right? So there's an ecosystem which needs to be supported to create and offer those solutions. Again, that will get split into what is viable today. As Naveen said, maybe small wind is viable or not viable, we don't know. But if it is viable, the ecosystem around delivery has to happen. And if because a lot of the financial market, banks and large developers are going towards the government demand, right? So there is a gap both on solution awareness and gap on financial awareness.
Thank you. Thank you very much. So I think now we have to summarize and wind up our session because we already crossed our time limit. So first of all, I would like to thank you to all of you, all the panelists, for joining with us, giving their valuable time for such an important topic. And I believe that this is required for everybody. Actually, this is not for the only panelists. This is for the audience also and the public at large, actually, because when we will discuss, we will create awareness and we will create solutions, then the outcome will come actually. And then we are saving our future also, not our children also. So I think we had a good discussion on the various aspects of the green financing from the developer point of view, from the lenders point of view, and from the investors also, and the people who are creating marketplace for the ecosystem actually. So this is a good discussion which we had today, and a lot of things have come out that retail bond and the funding to the small rooftop solar solutions, equity for the sustainable projects. These are the areas which need to be taken care well in advance, so that the India should take lead. Although we are, I think, I'm not aware that at what level we are in terms of our ranking, but definitely our ranking will improve whenever we'll go for these solutions and we'll create an ecosystem for sustainable finance or green finance in our country, where everybody will be benefited. So I would like to thank you once again to all of you, to all the delegates also, and to our Resurgent India team, who has done very good work, where they have organized this conference, this webinar. We invited all of us, and we could discuss on this such an important topic. Thank you once again. Thank you very much to all of you. Thank you.
Thank you.
Thank you all. Thank you. Thank you.